Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Is the most famous oat milk producer a good investment? In this video we will be analyzing if Oatly stock is a buy. Could Oatly, stock ticker symbol OTLY, finally be ready to move higher? Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Oatly. Oatly Group AB, a Swedish food company, was founded in the early 1990s leveraging research from Lund University. Their headquarters are currently in Sweden along with a production and development center. They focus on developing alternatives to dairy products from oats, with oat milk being their flagship offering. Their commitment to sustainability and using oats as a base has led them to create a variety of plant-based options including milks, yogurts, cream cheeses, and even ready-to-drink coffees. Today, Oatly boasts a global presence with their products available in over 20 countries and can be found in more than 60,000 retail stores and 32,000 coffee shops worldwide. Now let's look at the price action. Starting with the 1-year chart, we see that Oatly had a CAGR of about -45%. Zooming out to the 5-year chart, we see that Oatly had a CAGR of -62% over the past 3 years. Oatly has had a pretty bad run since the IPO. If we perform a backtest comparison of investing $10,000 in Oatly versus the S&P 500, we find significant underperformance for Oatly. Over the investment period, Oatly's ending balance would have shrunk to $1,369 compared to $11,493 for the S&P 500. This translates to an annualized return of -56.08% for Oatly versus 5.93% for the S&P 500. Oatly's investment was also considerably more volatile, with a standard deviation of 91.57% compared to 18.89% for the S&P 500. In terms of annual performance, Oatly's best year resulted in a 7.63% fall, while the S&P 500 grew by 26.19%. Conversely, Oatly's worst year saw a decline of 78.14%, compared to an 18.17% drop for the S&P 500. The maximum drawdown, which represents the largest peak-to-trough decline during the investment period, was -93.91% for Oatly compared to -23.93% for the S&P 500. Finally, risk-adjusted return metrics like Sharpe ratio and Sortino ratio also significantly favor the S&P 500, with Oatly at -0.51 and -0.79 compared to 0.20 and 0.30 for the S&P 500, respectively. Overall, Oatly underperformed the S&P 500 across nearly every metric. Now let's hop over to market share and take a look at Oatly's market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under beverage and see that Oatly is categorized as a non-alcoholic beverage. Expanding the non-alcoholic beverage tab, we can see that Oatly has very small market share but does seem to be growing. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for Oatly, OTLY, and see that the market share is just 0.09% out of the publicly traded food, beverage, and restaurant stocks currently in the market. Oatly attracts a very small amount of spend but is growing market share. The 5-year market share CAGR for Oatly is 11.28%. This means that Oatly's market share is outpacing growth in the wider food industry, restaurants included. If we start in 2020, we see that the market share was 0.065%, 0.086% in 2021, 0.087% in 2022, 0.091% in 2023, and 0.092% over the trailing 12 months. Oatly is clearly growing, showing me that they have product market fit. Let's take a look at the fundamentals. Gross margin is 22%. Not bad for a non-alcoholic beverage producer. Revenue has compounded at around 21% over the past 5 years and has reached over $787 million most recently. Oatly's revenue is growing very nicely. When we look at cash flow, we see a minus 40% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 29% CAGR. As a result, free cash flow has worsened at a 0.1% CAGR. Oatly is in the process of getting its operating cash flow under control, and I think capex is at a reasonable annual spend below $50 million. Oatly needs to work to bring operating cash flow into positive territory by increasing revenue and decreasing operating costs. Weighted average shares outstanding have grown a lot over the last 5 years, going from 454.3 million shares in 2020 to 594.3 million shares most recently. Oatly has been busy diluting shareholders. The good news is that the rate of dilution has slowed tremendously from 2022 onwards. I look forward to the day when Oatly actually starts to buy back shares. Now let's view return on invested capital. Return on invested capital has improved from minus 29% in 2020 to minus 21.1% most recently. Less negative is better. Hopefully Oatly can have positive return on invested capital one day. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 47 days in 2020 to 70 days most recently, Oatly has gotten way less efficient over time. A deeper dive reveals that this value has worsened due to inventory accumulation and Oatly paying their suppliers sooner. Management desperately needs to reverse these trends to improve this metric. Now, let's look at Oatly's debt. The net debt to EBITDA has changed over time, going from minus 3.4 in 2020 to minus 2 most recently. Given that Oatly is still unprofitable, not much can be learned from this metric other than knowing that the company still holds debt. The company has been improving, albeit very slowly. In any event, should it be added to the watch list? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the food fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Oatly. It is a beverage company with a gross margin of 22%. The 5-year revenue per share CAGR is 12% and the 5-year free cash flow per share CAGR is 8%. This is a good start. A decent gross margin and improving revenue and free cash flow. A return on invested capital of minus 21% is bad but getting better. Next, the cash conversion cycle of 70 days is horrible and getting worse. Concerning debt, a net debt to EBITDA of minus 2 means that Oatly is still unprofitable and holds debt. So from a fundamental standpoint, Oatly still does not look good. Now let's switch our attention over to valuation. Oatly is negatively valued relative to the S&P 500 with a ratio of minus 0.1. The price to earnings growth, or PEG ratio, could not be calculated given that Oatly is unprofitable. Oatly was a promising company. They rapidly grew revenue and market share, showing that consumers really do love their products. However, poor management and macroeconomic challenges soon overwhelmed the company. In recent quarters, the company has been making moves to improve the fundamentals. A year ago, they welcomed a new CEO and moved Tony Peterson to the co-chairman role. Flatin, the new CEO, came with seasoned experience in the food industry and has helped Oatly grow revenue and reduce costs. Let's also not forget about the lawsuit. Oatly recently forked over $9.3 million to settle a greenwashing lawsuit. Basically, investors accused Oatly of hyping up their environmental credentials and projects' demand to inflate their share price. Now, the settlement doesn't mean Oatly admitted guilt, but it is a hefty fine. This is a wake-up call for all those companies out there making bold sustainability claims. Investors are getting wise to greenwashing, and there can be real financial consequences. This was an unforced error from management and will have shareholders holding scrutiny the next time they see a company boasting about saving the planet. In my humble opinion, Oatly remains a company with promise. However, the fundamentals are still really bad, and with the book value per share at 50 cents, there is still more room to fall before things get better. For me, Oatly is not going on the watch list, but I do look forward to checking in again next quarter. Many thanks for watching. What do you think about Oatly and its amazing growth? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.